First notice day for the March COMEX silver contract is today, right now, not tomorrow, not next week, today. And here is the number that should make every person watching this stop whatever they are doing. March open interest is sitting at 37,162 contracts. That is 186 million ounces of silver, claimed, on paper, legally standing for delivery starting this morning. The registered silver in COMEX vaults available to back those claims? Approximately 88 million ounces, 186 million claimed, 88 million available. I am not going to call that manipulation right now. I am not going to call it a default. What I am going to do is walk you through exactly what those numbers mean, exactly what happens today and over the next 30 days, and exactly what the three most likely scenarios look like for silver's price. Because what is happening this morning is not theoretical anymore. The clock hit zero. The math is live. And the next 30 days will either confirm or contradict everything we have been tracking in this market since October. Let's build it from the ground up. Every number I give you today, you can verify yourself. Links to all data sources are in the description. Section 1. What first notice day actually means and what it doesn't. Before we get into the numbers, I need to be precise about what first notice day is and what it is not. Because a lot of content out there is getting this wrong, either dramatically overstating it or dismissing it entirely. Both are wrong. First notice day is the first day on which holders of long futures contracts, buyers, can be required to take delivery of the physical commodity. It is also the first day shorts, sellers, can issue delivery intentions. Here's what first notice day does not mean. It does not mean 186 million ounces of silver must be delivered today. It does not mean COMEX defaults today. It does not mean the price explodes or collapses in the next hour. Here's what it does mean. Starting today, any long holder who has not rolled their contract to a later month or closed their position is now in the delivery window. From today through the end of March, the physical delivery process plays out. The question is, how many of those 186 million ounces of claimed paper actually stand for delivery, versus how many roll forward, cash settle, or get convinced to walk away with a cash premium. That distinction matters, and I will show you exactly why the math is still deeply problematic, even if only a fraction of those longs demand physical metal. Section 2. The vault picture. As of this morning, let's establish the baseline numbers as of today, February 27th Eastern Time. COMEX registered silver, the metal that is legally designated and available for delivery against futures contracts, is approximately 88 million ounces. This number has been in free fall since October 2025. Let me give you the timeline so you can see the trajectory. October 2025, 167 million ounces registered. December 2025, approximately 130 million ounces. February 5th, 103 million ounces. February 11th, 98 million ounces. First time in the recorded modern data series below 100 million ounces. February 19th, 88.79 million ounces. Today, February 27th, approximately 85 to 88 million ounces. The drain has continued through this week. That is a 47% collapse in registered silver in roughly 4 months. Not a blip, not a single day event. A persistent, accelerating drain that has continued even as the paper price fell 29% from its January all-time high. Now here is the number most people are missing. Total COMEX silver, registered plus eligible, is approximately 300 to 310 million ounces. Eligible silver is metal stored in COMEX-approved vaults that meets quality standards but has not been designated for delivery. Eligible holders have chosen not to make it available. Why does that distinction matter? Because you cannot force eligible silver into the registered pool. The owners decide. And right now, with silver down 29% from January highs, eligible holders are not converting at these prices. They are waiting. So the deliverable pool today is approximately 85 to 88 million ounces. That is the physical reality this morning when 186 million ounces of paper claims wake up on first notice day. Section 3. The math that doesn't work. Let me show you the numbers plainly. No dramatic framing, just arithmetic. March open interest, 37,162 contracts. Each contract, 5,000 troy ounces. Total claims, 186 million ounces. Registered silver available, approximately 88 million ounces. Ratio, 2.1 paper claims for every 1 physical ounce available. Now let's apply historical delivery rates to understand the actual stress scenario. Normal major month delivery rate. Approximately 10 to 20% of open interest stands for physical delivery. At 10%, that is 18.6 million ounces demanded. At 20%, that is 37.2 million ounces demanded. The vault can handle both of those scenarios without breaking. At 88 million ounces registered, a 10 to 20% delivery rate is manageable. But February 2026 was not normal. February delivery rate came in at approximately 98%. 7 to 10 times the historical norm. 24.8 million ounces of delivery notices were issued in February alone, a minor delivery month. Wells Fargo issued 228 delivery notices. BNP Paribas stopped 155. The physical demand signal in February was unmistakably clear. Now, March is a major delivery month, the most active silver contract of the year. Historically, March sees higher participation than February. If March delivers at even 50% of February's rate, that is still 3 to 5 times historical normal. At 50% of February's behavior, you are looking at 40 to 50 million ounces standing for delivery against an 88 million ounce vault. That is manageable. Stressful, but manageable. Here is where it gets genuinely uncomfortable. If March sees delivery behavior anywhere near February's 98% rate, you are looking at 60 to 80 million ounces of physical demand hitting a vault with 85 to 88 million ounces. That is not comfortable. That is a vault running at near zero buffer with delivery requests still coming in through the end of March. And here's the key variable nobody can predict with certainty. How many of those 186 million ounces of paper holders actually want physical metal versus how many are speculating and will roll forward? That number starts revealing itself today. Section 4. The 3 scenarios. What actually happens this month? I always give you both sides. The honest analysis includes scenarios that are not dramatic as well as scenarios that are. So here are the 3 most likely outcomes in order of probability based on available data. Scenario 1, the managed roll, most likely. Banks and exchange participants execute what analysts are calling a shadow bailout. JP Morgan and other major dealers use exchange for physical arrangements, EFP, to pay significant cash premiums to large long holders, convincing them to roll their delivery demands to London or to a later contract month. JP Morgan has already closed significant short positions. SLV, the silver ETF, holds approximately 91 million ounces in its New York vault. There are credible reports that this eligible pool could be used to supplement registered delivery supply if needed. Under this scenario, March delivery stress is real but managed. The vault holds. The paper price stays volatile but does not break above $95 in the next 30 days. The structural problem is not resolved. It is deferred to May, July, and September, which face the same math on a smaller scale. Why is this most likely? Because COMEX has managed delivery stress before. Because eligible silver exists as a potential buffer. Because large institutional holders often prefer cash premiums over the operational complexity of taking physical delivery. And because exchanges have multiple tools, margin hikes, delivery rule adjustments, EFP cash outs, that can reduce standing demand without a formal default. Scenario 2, partial break, possible. Delivery demand in March exceeds what the managed roll can absorb. Registered silver drops below 60 million ounces before the end of the month. The exchange raises margins significantly, as they did in February in the dead of night, multiple times. This forces out more leveraged longs. Price swings are violent, potentially $10 to $15 intraday moves. Shanghai premium widens further above the current $26 level as physical demand accelerates outside Western paper channels. Under this scenario, COMEX does not formally default, but the mechanics become visibly strained in real time. Cash settlement becomes more common than physical delivery on individual contracts. The credibility of the paper pricing mechanism takes damage. Silver's price discovers a new higher range, potentially $95 to $110, as the market price is in ongoing structural stress. Scenario 3. Formal delivery failure on individual contracts, less likely but not impossible. Registered silver is exhausted before all standing delivery demands are satisfied. Individual contracts cannot be fulfilled with physical metal. Cash settlement is imposed on some contracts rather than physical delivery. This is not a COMEX system default, COMEX itself would not fold, but individual contract holders who expected metal get cash instead. This scenario is less likely because the exchange has many tools before it reaches this point. Margin hikes, EFP incentives, eligible reclassification, rule changes. But it is not impossible. The Hunt brothers episode in 1980 ended with the exchange unilaterally switching to liquidation-only mode. No new long positions permitted. Silver Rule 7. That is an extreme measure, but it has precedent. For what it is worth, Investing.com published an analysis this week stating directly, COMEX will not be allowed to default. Their argument, the exchange has too many institutional tools to let it reach that outcome. That is a credible view. It is also not the same as saying nothing dramatic happens in March. Section 5. The December precedent. What already happened. I want to go back to December 2025 because it is the most important data point we have for understanding what March might look like. In the opening 4 trading days of the December 2025 delivery window, COMEX processed approximately 47 million ounces of silver delivery. To put that in context, historical December delivery had typically been 10 to 20 million ounces for the entire month. December 2025 saw nearly the full historical monthly total in 4 days. That was a minor month. Less participation, smaller open interest than March, and it still produced delivery demand 3 to 4 times the historical norm. The market's response to December's delivery pressure was a price move from approximately $53 in late November to $121 by January 29th. That is a 128% move in roughly 60 days. Driven by structural delivery pressure, Shanghai premium, and COMEX inventory drain hitting simultaneously. March is a major month. More participants. Larger open interest. The same structural pressure that existed in December has not resolved. The vault has continued draining from 130 million ounces in December to 85 to 88 million ounces today. December was the warning. March is the test. Section 6. The Wells, Fargo, and BNP Paribas data point. Let me give you a specific data point from this week that tells you something about who is standing for delivery and what the bank-level behavior looks like. On Tuesday of this week, 3 days before today's first notice day, 229 delivery notices were issued for February contracts. That represents over 1 million ounces of silver cutting in line for delivery in the final days of February. Wells Fargo issued 228 of those notices. BNP Paribas stopped 155, meaning BNP took the other side, accepting delivery rather than rolling forward. Total February COMEX silver delivery notices rose to 4,160 contracts, 24.8 million ounces, for a minor delivery month. What does Wells Fargo issuing 228 delivery notices in the final days of a minor month tell you? It tells you that institutional demand for physical metal is not a retail phenomenon. It is not a Reddit squeeze. It is happening at the bank level. Wells Fargo is a major financial institution. When Wells Fargo issues delivery notices at that volume and frequency in February, a minor month, you pay attention to what they do in March when the stakes are higher. This is verifiable. It is in the public CME delivery reports. Pull them yourself. The link is in the description. Section 7. The Shanghai factor. Still there this morning. One more piece of the picture before we get to what you should actually watch today. While COMEX is processing first notice day this morning, Shanghai is not sleeping. As of the most recent data available, Shanghai silver maintains a premium of approximately $26 over Western spot prices. At current Western prices around $87 to $89, Shanghai physical is trading at 113 to 115s. That premium has been persistent through February. It did not close when Western prices fell. It widened. And China's new export licensing system implemented January 1st, 2026 ensures that physical arbitrage cannot clean up that gap. What does a persistent $26 Shanghai premium on first notice day tell you? It tells you that the physical silver market globally is not pricing metal at $87. It is pricing metal at $113 to $115. The paper market in New York and the physical market in Asia have been running on different tracks since January. Today's first notice day is one of the first moments where the paper market in New York has to face whether its price is real, because real delivery demands are now arriving. Section 8. What the bears are saying and why it matters. I want to be fair to the other side of this argument, because honest analysis requires it. The bear case on March delivery stress is not stupid. Here's the strongest version of it. March is a major futures month. Major months have historically seen lower delivery percentages relative to open interest than minor months. The reason is that March participants include hedge funds, commodity trading advisors, and speculators who use futures for price exposure, not for physical delivery. They roll. They always have. Projecting February's 98% delivery rate onto March is the wrong model. Additionally, warehouse receipts, the actual mechanism of COMEX delivery, represent ownership transfers, not physical metal movements. Silver typically stays in the vault. A delivery is a change of title on a warehouse warrant, not a truck pulling up and loading bars. The same 88 million ounces can process significant delivery volume without moving. Gold Silver published a detailed analysis this week making exactly this point. Their conclusion was, COMEX default is not the right framework. The real question is whether orderly repricing happens, and long-term silver investors benefit more from orderly repricing than from market chaos. That is a reasonable position. I am not dismissing it. I am telling you to hold it alongside the delivery data we have actually seen in this cycle, because the bear case assumes March behavior reverts to historical norms. The entire point of the analysis we have been building since October is that this cycle is not behaving according to historical norms. Section 9. What to watch today and through March. All free, all public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on a paid service, that is a scam. You find me here on YouTube and on X. Data drops on X when it breaks. Here's your watch list. Every item is public and free. CME Daily Delivery Reports, published each afternoon by CME Group, shows delivery notices issued and stopped by bank and institution. Today's report, published after 3:00 p.m. Eastern, will be the first data point showing how many March longs actually stood for delivery on day 1. This is the most important single data point you can watch this month. Link in the description. COMEX registered silver inventory, updated daily at the CME website. Watch whether registered silver stays above 85 million ounces through the first week of March or continues draining. A drop below 80 million in the first 10 trading days of March would represent significant physical stress. Silver spot price around key levels. 87.50 is the immediate support. 92.75 is the technical resistance that, if broken on sustained volume, confirms bullish continuation. 85.93 is the structural floor. Watch for intraday moves larger than $3. Those signal institutional positioning changes, not just retail noise. Shanghai premium. If the premium widens past $30 while COMEX is processing March deliveries, Asia is telling you the physical market is repricing faster than Western paper admits. Margin announcements from CME. In February, CME raised silver margins multiple times, including once at 11 p.m. Eastern on a Sunday night. Margin hikes reduce the leverage available to long holders and force out speculative positions. A margin hike during March delivery would be a signal that exchange operators are seeing delivery stress and are deploying tools to manage it. CME posts margin announcements publicly. Exchange for physical premium data. EFP is the mechanism through which COMEX can move delivery demand from New York to London. When EFP premiums spike, it means New York is paying to move physical demand offshore. Elevated EFP premiums would confirm that managed roll scenario 1 is actively happening. Section 10. The honest conclusion. Here's the full picture as of 8:30 a.m. Eastern, February 27, 2026. Silver at $87.47, trading in a range of $87.21 to $90.27 this morning. March first notice day is live. 37,162 contracts, 186 million ounces of paper claims, 88 million ounces registered in the vault, 2.1 paper claims per physical ounce available for delivery. COMEX registered silver down 47% from October 2025, February delivery rate at 98%, 7 to 10 times historical normal. Wells Fargo issued 228 delivery notices in the final days of February, a minor month. Shanghai maintaining $26 premium over Western spot. China's export licensing blocking clean arbitrage. Physical silver in Asia pricing at $113 to $115, while New York paper prints 87. December 2025 was the warning. 47 million ounces demanded for delivery in 4 days of a minor month. March is a major month with larger open interest and the same draining vault. 3 scenarios: managed roll most likely, partial break possible, formal delivery failure on individual contracts less likely, but not impossible. The math does not add up in a clean, comfortable way. 186 million ounces of paper claims does not fit neatly into 88 million ounces of registered silver. What happens in the gap between those two numbers, whether it closes through rolls, cash premiums, eligible reclassification, or actual delivery stress, that is what the next 30 days of data will tell us. I am not here to sell you the most dramatic outcome. I am here to tell you that something structural is happening in this market that the daily price chart does not fully show. The vault trajectory, the delivery data, the Shanghai premium, the bank level behavior in February, they are all pointing in the same direction. Today is when the theory meets the calendar. Pull the CME delivery report this afternoon, check the registered inventory tomorrow morning, watch the margin announcements. The data will tell the story. Your job is to actually look at it. Most people will not, because looking requires acknowledging that the system might be running on fumes behind the price you see on your screen. The minority who look do not need convincing. They simply adjust. Invest with logic, not hype. Protect your capital. Respect the plumbing as much as you respect the chart. Drop OG John AG or just OG in the comments if you pulled the CME report today. That is how I know who is actually watching the data and who is just reading the headlines.